Why didn't mortgage rates budge after the Fed meeting? Everyone was screaming online this week about what the Fed should do, saying, cut rates already. Why haven't mortgage rates dropped? Meanwhile, mortgage rates didn't move at all. So what happened? Let's break it down and give you the real takeaways and not just the clickbait ones. This week, the Federal Reserve held the federal funds rate steady as expected, but something rare happened. Two members of the committee dissented. That hasn't happened in over 30 years. It signals internal disagreement about how long we should hold current rates. Jerome Powell gave his usual press conference after the announcement, but here's what most people missed. The market barely flinched. Mortgage rates stayed flat. Now why? Because the Fed doesn't control mortgage rates, and more importantly, because nothing in the data told investors to change course. Everyone wants to believe that a Fed meeting is going to change their mortgage rate, and it makes for a good headline, right? But in reality, mortgage rates follow the bond market, and that market is looking at long-term trends, not what Powell says in a 45-minute press conference, unless he does something absolutely insane. Earlier this month, we had a very strong auction of U.S. Treasury notes. Investors actually paid a premium, which suggests confidence in current yields. If markets thought a rate cut was imminent, they would have priced that in already. Here's where it gets interesting. The Fed isn't trying to be trendy. They're not reacting to headlines. They move based on trended data. They do not respond to anticipated economic events, rather to what has already happened. And the data right now, not great for rate cut hopefuls. Just this morning, the core PCE report, one of the Fed's favorite inflation metrics, came in 0.3% higher than expected. That throws cold water on any talk of easing. Powell even pointed out one under-discussed contributor, tariffs, and I quote, higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. Here's the translation. Tariffs might be a temporary spike in prices, or they could drive more persistent inflation. The Fed doesn't know yet, so they're not moving. Remember, just a few months ago when everyone was saying they expected 4 rate cuts in 2025. Now the odds makers are saying there's less than a 40% chance of one in September, maybe 2 for the year. Most of those early predictions were more wishful thinking than sound analysis. Now, I'm not saying it's the right or even wrong call. I'm pointing out that the Fed is never going to anticipate. They're only going to react. So what are the takeaways for realtors and buyers? This is where the rubber meets the road. If you're a realtor, you need to understand that buyers waiting on rate cuts may be waiting too long. If you're a buyer, the truth is today's rate is real. Tomorrow's rate is just a story. The bond market isn't betting on quick moves down, neither is the Fed. And in the meantime, the right home at today's rate might still be waiting months for a rate that never comes. If you found this helpful, tomorrow we're going to go even deeper. I'm going to unpack quantitative easing. Most loan officers have no clue what this is or how it affects rates. So we're going to talk about what it really meant during COVID, why it was the true driver of record low rates, and why it's probably not coming back anytime soon, with one caveat that I'll talk about tomorrow. If you've been wondering why mortgage rates haven't responded to Fed moves the way they used to, this next one is something you're going to want to check out. So when you hear people screaming for rate cuts online, remember, the Fed isn't on Twitter. They're watching inflation, consumer spending, and job reports. And until the trend changes, mortgage rates are going to continue to do their own thing.